Hi, I'm Lynn Adams.
I'm Jason Shore.
Hey, we appreciate you taking time out for our impromptu version of Video Insight. We're going to talk a little bit about some of the questions that we're getting in regards to the market and the coronavirus. I've got here, Jason is on our team, who's a part of our technical analysis team, does a lot of work in tracking portfolios and that kind of stuff. We wanted to really just take a moment and sort of really do this live cast on 4 or 5 of the questions that we're getting, because I know everybody's concerned, and the calls are just rolling in. So I think, what are some of the questions that we're seeing a lot of right now?
I think first and most importantly, how low will it go?
Right. So, we know that the market ultimately is driven by earnings, and of course multiples of earnings. People, when they're confident, they're going to pay higher multiples. When they're not confident, they pay lower multiples. I think to try to get some construct as to how low could the market go, I think if you look back at some historical big events like the financial crisis, or perhaps 9/11 and it's sort of what happened back then, or maybe even back in the S&L crisis in the 80s. In my experience, and tell me what you think, but my experience is that PE ratios, the multiples applied to earnings in some of those horrific times, they get down 11, 12 times earnings, right? So where are we at the moment?
We're not near that yet. We're below historical average. So we're slightly cheap, but we're certainly not cheap on a long-term basis of when it's a screaming buy at this point.
Right. So I think last time we looked, maybe it was around 15 times earnings or so. 20-year average is 17 or so.
Yeah, 16 and a half, 17.
Right. And like I say, relative to other historic moments where there's just a lot of stress on the market, a lot of unknown uncertainty. The financial crisis, we saw large cap stocks in the U.S. get down to 12 times earnings, 11.5 times earnings. So we certainly see that it could, if this were to precipitate into more of an actual true recession. People lose their jobs, and then when it's over, they don't go back to work.
Yeah. The recovery is very slow.
Right.
Which we just don't know that yet.
We don't know. Now, another thing is going to happen is in a couple of weeks, we'll start to see first quarter earnings. We'll start to see these companies report, and we'll really get our first glimpse at, how bad is this on the economy? And I think it's a mixed bag. I think for the most part, things are going to be hurt because a lot of the sectors, gaming, airlines, retail,
hospitality, restaurants,
cruise industry for sure. I think those are sectors that we all know are going to be troubled in a great amount, and it filters into other things. But in the midst of the craziness, there is still silver lining. I don't know about everybody else, but if you went to Lowe's this weekend and they are slam packed all day,
Costco lines out the door.
Right, and if you got to stay at home, I think people think, oh gosh, I might want to fix my house. I'm gonna go to Lowe's and get da 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 da. So there's some, or the takeout, or the Uber Eats, so there's some mixed bag, but I think fundamentally it's negative. We just don't know how negative it's going to be.
Things are discounted from norms, but not cheap by any stretch right now.
So, I think that when you put that into practice, how low can it go? I think we're down. The S&P's down year to date in mid-20s, if I'm not mistaken. Just like we talked about in our first quarter conference call, there are things out there that could make the market go down 20 to 40%. We may get closer to the 40% before this is over. Not saying that we will, but I think we have to be prepared for that. We're risk off with our assets, so most of our stock exposure has really been minimized at the moment. Let's talk a little bit about the bond market, right? Because we're out of stocks, but we still own a lot of bonds. And we're seeing some dislocations in the bond market, right? Some of the bonds,
especially in the last week, we've seen, what you consider your safe assets lose a couple percent or more, depending on where the bonds are at on the credit spectrum. So that tells us two things, really. If you want to tackle the first one.
So one is supply and demand, right? For the last 12 years, 15 years, the asset category of choice for the majority of our population, particularly the boomer-driven population who's retired, is the bond market. People don't want to own cash because it doesn't pay enough money. People don't want to own bank deposits because it only pays a small amount of interest, so they buy bonds. There's a lot of different kinds of bonds. Most people have been disenchanted with government bonds because the yields have been essentially zero or close to zero, so they've been buying credit, basically corporate credit. Now, we have two kinds of bonds. We have bonds that are our long-term holding bonds, which will be longer in duration, maybe have some more credit risk, maybe some international, global feel. But our risk-off counter trades. When we came out of equities, we also owned some ultra short bonds. Now, a lot of those are still corporate, but they're ultra short, so they haven't lost as much money as maybe the long-term, credit-based. I mean, the worst bond fund out there that we see is probably down about 10%.
Yeah, 10 to 15%.
And we have a little bit of exposure to that, but we also think of some screaming deals in there as well. But our risk off money is in things that are ultra short, and I mean, they're down maybe 1 to 2.5%. So there's different kinds of bonds, but there is a dislocation going on because there's a ton of people selling because they want cash. I went to Bank of America in Apex 2 days ago. I need to get some cash because I'm trying to pay a couple guys to do some stuff that like landscaping work, and they're like, we don't have any cash. We have had all these people come in and want to get all the cash they can. So with that information, I think we have a similar thing in the bond market. There are people saying, hey, these are great bonds, are issued by companies that can certainly pay these debts, and they're all coming due in the next 6 months, a year, 2 years, 3 years. I don't think the question is, are they going to be able to pay the bonds? I think it's a cash crunch. There's just not enough people looking to buy these bonds at the moment, so you're seeing the prices go down because they got to sell them to somebody.
And the large financial institutions, hedge funds, pension funds, they need, when volatility expands across stocks, bonds, any asset class, they have to sell positions. So that means other institutions know that, so they're not going to pay asking price. They're going to say, I'll buy it from you, but I'm going to buy it from you at a discount because I know you're hurting. So that doesn't change the underlying holdings.
Right.
It just is a short-term phenomenon that some people are in a cash crunch, so you have to sell everything so you get taken to the cleaners.
Yeah. I think it's so in the bond market, if you kind of had to summarize, I feel like that we're very diverse in our bond holdings. Our counter trades, which is our dry powder, we have a combination of treasuries, a combination of ultra short corporate credit, like ultra short, like
90 days.
Right. And then we have a little bit of maybe normal short-term stuff. But those pieces are relatively safe in the grand scheme of things. They are maybe moving up and down 1% over while the market's up down 20%. We also have in our core portfolios, we have long-term bonds that are a part of all core portfolios, and those are down right now because of the squeeze that we're talking about with the bid and the ask. They don't make up a giant percentage of anybody's assets, but we own them, and I feel like that we shouldn't sell them at this point. I mean, it's a little bit of a dogma atmosphere, and I know like in the financial recession, the financial crisis, we actually had a lot of investors back in 2008 that really didn't want to get into stocks. We said, well, look, let's buy these bonds of these same companies because they're good companies with credit paying ability. And when the market actually began to recover in 2009, people made more money in corporate bonds than they did in stocks for the first 6 months of the recovery.
Yeah, they went first and fastest.
Right. So I'm not a big fan at this point of selling those positions. I think if people need to get access to cash, we'd use counter trade money and use some things that really haven't been hurt much at all. But it is an interesting phenomenon because there's people running for the door in the bond market, and you're going to see more about that if you haven't already noticed. So stock market, we're maybe on a potential halfway to the bottom if things continue to deteriorate and it becomes a real economic event, meaning jobs get lost and they don't come back. The bond market, there's some volatility happening, but expect 1 to 2% type volatility in a given month for the short-term stuff, and if we've got some longer-term holdings in there, maybe 3 or 4% in a given month. Nowhere near like stocks, but there is volatility there. Another question that we get a lot right now: should I put money to work? I want to invest in the dips, right? What's your thoughts on that?
If you could tell us when the virus would pass, or if we had clarity on is it a 2-month versus 2-quarter issue, I think we would have the perfect answer for you.
Right.
But honestly,
we don't know.
We don't know. Yep.
So I'm telling you, I get that question more than anything right now, because we got a lot of our clients that had money and safe money and building up in their savings account, whatever, and they're like, man, it's a good time to buy. This is definitely a better time to buy than January was.
Yeah, than 2 months ago.
Right? But is this the best time to buy? I think is kind of like trying to catch a falling knife. you might grab it right at the bottom, but you might get hurt.
Yeah, might lose a finger.
Right? So I think the right way to handle the concept of I want to take advantage of this market dislocation and the fact that there's squeezes on bid-ask spreads and there's pricing anomalies is to have your cash in a position when the market stabilizes that you can quickly go in and pick up the things you want to do. And right now, if you were, for example, to add money to one of our strategies that's risk off, that money's mostly going to be sitting in a counter trade position. Mm-hmm. So we're not going to invest it today. But once the market settles down and the 200-day moving average slides down to where the market is, and those two positions get inverted, we'll re-enter. So I think our process will help people that want to get money invested in this market get in at a time that's maybe not the very, very bottom, but it will be very attractive relative to what we've seen for the last couple of years. And I think it's a safer way to enter to do it that way.
Yes, cheap can get a lot cheaper, and if the economic data slows down over quarters, then the market's going to give us much better opportunities to buy things that are deeply discounted than it would be right now.
And we're going to get some interesting things happen the next 3 weeks. Like I say, when first quarter earnings come out, there's going to be some clarity. How bad is it? I think everybody right now scratching their head going, it's just terrible. And so the market has priced in, it's terrible. One of the points in the book we wrote last year, the 25 Lessons book, is that the markets tend to go down on the rumor of bad news, and more often than not, when the bad news actually comes out, they tend to recover back up to some degree because they've priced in what people believe to be worst case scenario. And when the news comes out and we kind of can get some more sense of, well, how bad is it really going to hurt earnings, I think you might see the market have a little bit of a bounce, but I wouldn't necessarily say that that's the end of this. I would say that it's just going to be precipitated by how much more things are impacted by the coronavirus, how many things get shut down, how many people aren't spending money. But I'm very comfortable, and I hate to say this because everybody's lost money this year, okay? That's a fact, all right? But I'm very, very comfortable when I'm looking at my conservative clients and saying, hey, look, we've made a lot of money last year, we made good money for the last 5 years, and this year we're down 4 or 5% or 6%. My aggressive folks, that just want to make all the upside and have some limited downside. When the most aggressive clients that we have might be down maybe 17% in a market that's down 25, 30, especially if you've got global exposure. I know it stinks to be down, but I think that's a great place to be relative to being directly in the market, and we have a lot of dry powder. So when we find a lower level that the market stabilizes and we put that dry powder back to work, that's when I think it sets the stage for a potentially very good 2021. But that's making the assumption that the virus thing kind of tapers off and that we get back to some sort of life as normal. And we just don't know that's going to happen. But I'm comfortable with where we're at in terms of our protection mechanisms. What other questions? Do you think anything else that people are asking?
I think that's it. How low is now a good time? Bond issues, and then the overall, how long does the virus last? Does it become a stock market event, turn into an actual economic, a new normal lifestyle event, which right now we just don't know.
I think one last thing that's worth just throwing out there that we're not collectively paying attention to is that the stimulus that the government has implemented, emergency stimulus, it is radical. I mean, it's unbelievable radical. Federal Reserve went from raising rates quarter point per quarter, trying to get back to normal, to saying, we're done with that, we're going to zero on interest rates. I mean, the amount of money that the consumer is going to have in their pocket on the other side of this, just from refinancing their loans, for corporate America refinancing their debt.
Gas being drastically lower.
Unbelievable, right? I mean, I think I paid $1.90 or $1.80. I mean, I haven't seen that since college, right? So more money in your pocket on the other side of this, the $1 trillion of extra stimulus going to people to help with everything from municipalities deal with the shortcomings in cash flow, to people getting laid off, to unemployment, to people suffering from their kids can't go to school, so I have to miss work. Well, here's some money to cover those. I mean, it is a radical government action on the economic side. So on the other side of this virus, all that money is still at work, and that could easily propel the market to levels that we just can't quite comprehend, because it's crazy amount of stimulus. So I think there is some silver lining. We're here if you need us. We just wanted to get out in front of you because we're getting a lot of calls, a lot of questions, and we appreciate the opportunity to serve you. We're doing things every single day that we think will help make sure that on the other side of this, we've taken advantage of the things that we should have in a smart way, and we're also here to help you just manage sort of the emotions, right? The emotions of all this, right?
Yep. Take care of yourself and your loved ones and the community, because let us worry about this portion and you worry about taking care of your family.
Yeah, and I would just say lastly, it's not that often I get to just sit at home and not have a lot to do with my kids and my wife, and I think that we all are having that happen as workers are trying to work from home and stuff. Like try to enjoy that. I mean, it's we don't, people that like me, Jason, our team that work all the time, like we don't get that opportunity very often. Like embrace it for what it is, because it isn't. I mean, you may never get it. You know what I mean? We don't ever get that opportunity. So take advantage of the time you got. There's probably things around your house you've been trying to find the time to get done. Do them. I mean, now's the time. All right, well, we're here. Have a great day. Hang in there. If you need us, give us a call. You have our number. Just a couple things from a disclosure standpoint, that everything we've talked about today is for educational purposes only. Nothing in this call is intended to be investment advice or something that you should act on. In regards to market update items, it's not past performance is not indicative of future returns. There's no guarantee with investments, which they're going to go up or down. And we are registered investment advisor representatives with Cetera Advisor Networks LLC, and that is a member of SIPC. Thanks a lot. Have a great day.